In this video, we're going to see how you can use LV Financials to help you determine how much you could save by refinancing your mortgage. To do this analysis, you'll need a paid account, which will give you access to the premium tools. To start off, go to the Tools drop-down in the top right and pick the Loan Planning Dashboard. You'll want to go to the Amortization Schedule tab. The first thing you need to do is enter in the original loan terms that you got for your mortgage. So for the purpose of example, let's suppose that you paid a principal of $300,000 for your home. To keep things simple, we'll assume you had no down payment, so we'll leave this at 0. We'll leave the interest rate at 5%, and the mortgage loan term length we'll leave at a 30-year amount, which is typical of mortgages. The first thing to do is to scroll down and look at the loan details on the right. The numbers you want to write down are the total cost of the loan, this total interest paid, which you can see is $279,767.35. You also want to look at the monthly payment, which is $1,610.46. You should write these numbers down. So we're going to use this little pad here and just record that information. So you can see our initial loan terms. We have a principal of $300,000, 5% interest for 30 years, and we've written down the total cost and the monthly payment. I've left off the cents here because they're not really going to matter too much, and this will keep the calculation simpler. The next thing you want to do is determine how much equity you have in your home. So let's go back to the amortization schedule. And let's suppose that at the current time you are 5 years into your loan. So the first thing you need to look at is this dashed purple line. If you hover over it and find the point at which the installment schedule is 5 years, 0 months, you can find the cumulative principal that you have paid on your loan so far. You can see here that that amount is $24,053. You'll also need to find the cumulative interest paid, which you can find by looking at the dashed pink line. If you hover over it and find the point where the installment schedule equals 5 years, 0 months, you can find the cumulative interest paid, which in this case is $70,964. At this point, you should write those two numbers down as well. So we'll go back to our pad, and you can see that we've recorded these numbers. So 5 years into the loan, you've paid roughly $24,000 in principal and roughly $71,000 in interest. Now, something that you might want to look at is the current equity that you have in your home, because it's possible that you might not be eligible for refinancing if you don't have a certain amount of equity. Typically, these amounts are either 10 or 20%. But using the numbers that you've written down so far, you can calculate how much equity you currently have. So let's start off assuming that the house is still worth the original $300,000. In this case, you can divide the principal paid so far by 300,000 to get a decimal of 0.08, which when multiplied by 100 comes out to 8%. So you have 8% equity, assuming the house is still worth $300,000. However, it's very unlikely that over the course of 5 years, the house will remain at a constant value. Generally, the value of the house changes over time, and in good economic conditions it tends to increase. So a better assumption might be to base the equity calculation off of the expected increase in the home. Or if you get the home reassessed, you can enter in a definite number here instead of your estimate. For this example, we're going to suppose that the house value has increased $10,000 in 5 years and that it is now worth $310,000. Because you're not paying on the appreciation of your home, you can simply add the appreciation into your principal paid, divide that by the new value, and multiply that decimal by 100 to get the new equity, which is 11%. So at this point, you know what your equity in the home is, and this should help you figure out if you're eligible for refinancing. The next thing you need to do is look at the terms of your refinanced mortgage. For the purpose of example, we're going to suppose that your refinanced mortgage will have an interest rate of 3%, which is lower than your original interest rate of 5%, because it wouldn't really make much sense to refinance if the current interest rates are higher than they were when you took out your original mortgage. We're also going to assume that the refinanced mortgage has a term length of 30 years. The principal of your new loan is simply the original principal minus the principal that you have paid so far. So this $279,767 is the amount of principal that you have left. So your refinanced loan would be for this amount that you have not paid yet. So let's go back to the amortization schedule and enter these numbers. If we scroll up to the top, there are basically two ways you can do this. You can enter in the new principal here after subtracting your current cumulative principal paid yourself, or you can just find that number of cumulative principal paid, $24,053, and enter that as a down payment, because the down payment is essentially just going to be subtracted from the principal. Now we'll update the interest rate to 3%, and we'll keep the loan term length at 30. So now when you scroll down, there's two numbers that you'll want to look at here in the loan details table on the right. The first one is the total cost of the loan, or the total interest paid. That's $166,931. The other number you want to look at is the fixed monthly payment, which is $1,163. You should write these numbers down. So let's go back to our pad and record those values. So you can see here that for the refinanced loan, your new total cost over the lifetime of the refinanced loan is $167,000 approximately. And your monthly payment is now roughly $1,100. Now that you have all of the required numbers written down, the last step is to calculate your savings. To calculate the total savings in terms of interest, you start with the original interest that you paid for your original loan, which was $279,767. That's the original total cost. Then you subtract the cumulative interest that you have paid 5 years into the loan, which was $70,964. And then from that amount, you subtract the total cost of the new refinanced loan, which is $166,931, giving you a calculated savings of $41,872. Now you can do the same thing for the monthly payment by starting off with the original monthly payment of $1,610, then subtract the new monthly payment for the refinanced loan, which is $1,163, giving you a reduction in your monthly payment of $447. So that's it. That's how you can use LV Financials to determine how much you could save from refinancing your home mortgage.